Hi there, I'm Doireann Mc Dermott, and today we're going to have a look at the Chinese economy, as we recently witnessed a 7.7 increase in first quarter GDP from a year earlier. To discuss this with me in further detail, I am joined on the line by Stephen Schwartz, Asia analyst at BBVA in Hong Kong. Now Stephen, this was pretty disappointing news, and many were not expecting it at all. Were you surprised by this result?
Well, the first quarter GDP outturn at 7.7% was a disappointment relative to our and market expectations more broadly. It's still a respectable outturn. It's still a strong growth figure. But we had expected a first quarter of 8.2%, a little bit above the consensus at 8%. And it's disappointing because it means the pickup in growth that we saw beginning in the last quarter of 2012 has stalled. Now, a number of people in the market have started marking down their full-year growth estimates. We already had a conservative estimate of 8% for 2013, and at this stage we're inclined to keep that in the expectation that growth momentum will gradually pick up during the course of 2013 as the external environment improves.
And Stephen, Moodys cut its outlook for China from positive to stable due to concerns over excessive local government borrowing. Now, are you also concerned about this?
Yes, we continue to monitor a set of domestic financial fragilities in China, which include the buildup of local government debt, the rapid pace of unregulated shadow bank lending, and also the rise in property prices and the risk of bubbles in the property market. We view these three risks as medium-term in nature, and we take some comfort in knowing that the authorities are well aware of these risks and have been taking measures over the past few years to curtail them. But the authorities face a difficult challenge because they're walking a fine line between trying to provide support for the economy to maintain a high growth rate through various stimulus measures using both fiscal and monetary policy, but at the same time trying to prevent these financial risks from growing. And some of the stimulus measures themselves are at the root of those domestic fragilities. So there's a balancing act going on, and yesterday's disappointing first quarter GDP number makes that balancing act all the more challenging going forward.
And now let's have a look at market reaction as a result of this data. Stephen, can you tell me your thoughts on commodities which have been badly affected, and of course your thoughts on the performance of the renminbi?
Well, first on the renminbi, actually we're seeing the renminbi continuing to strengthen against the U.S. dollar. We're almost at a historic high for the renminbi against the U.S. dollar at about 6.18. We had expected gradual appreciation to continue in 2013 along a similar pace to last year. We had penciled in about a 2% appreciation against the U.S. dollar, which would take it to about 6.1 per U.S. dollar at the end of 2013. And there's been an even more significant appreciation in effective terms, that is against a broader basket of China's trade-weighted trading partner currencies, because of the weakness of the Japanese yen and the strength of the dollar. So up till now, the authorities are showing signs of allowing appreciation to continue, and as long as the external environment continues to improve, we would expect that to continue despite the disappointing first quarter GDP outturn. The broader financial market implications of yesterday's disappointing GDP outturn, as you mentioned, have been quite noticeable in commodity markets. That's not surprising because China is the world's second largest economy, and it has an enormous appetite for commodities. In some years, taking in half of the world's commodity imports of items such as iron ore. That's not uncommon. So it stands to reason that there would be a sell-off in commodity markets at any hint that China's growth and commodity demand would decline. But I think we do need to keep in mind that some of the movements in financial markets have other factors behind them, particularly the sell-off in gold. I would not necessarily attribute all or even the majority of that to the weak China data. There's a host of other factors, including improving global risk sentiment, rumors of central banks selling gold, and gold, of course, has been at very elevated levels for some time. So the people who study that market have been expecting some correction, and I think that's what we've seen in the last 24, 48 hours.
Thank you very much, Stephen. Well, viewers, that is it for today, but do stay tuned to Dukascopy TV for more Forex updates and analysis. But for now, goodbye.